If you don't hold it, you don't own it. If you have wealth in those fiat money products, you own risk. That's all that you own. And hey, you own a diminishing asset because the value of the dollar will continue to decline until it physically goes away, period. And we're very, very close to that. Could it be this September? Maybe. I'm seeing a lot of parallels between now and 2007 and 2008.
Gold prices hovered near an 8-week peak on Wednesday following recent economic data that reignited hopes of a potential pause in the U.S. Federal Reserve's interest rate hiking cycle. On Tuesday, gold reached its highest level since May 24th, hitting $1,984.19, before settling about 1.2% higher after U.S. retail sales for June rose less than expected. This development made gold more affordable for overseas investors. The dollar index wobbled near a more than one-year low after experiencing its worst week of 2023. Lynette Zang, the chief market analyst at ITM Trading, believes that the dollar is continuously declining and suggests that we may be approaching a point where it could disappear completely, possibly as early as September. Consequently, gold buying is increasing. In a recent interview, Lynette highlights that when interest rates rise, the value of bonds decreases. To mitigate this volatility, central banks shorten the maturity of bonds. However, this strategy can lead to higher costs when replacing the bonds at higher interest rates. Lynette suggests that gold is considered the safest option for central banks and individuals, as all fiat currencies face similar challenges. According to a survey of 57 central banks and 85 sovereign wealth funds managing approximately $21 trillion in assets, many sovereign investors expressed concerns about the precedent set by confiscating Russian assets. As a result, 96% of respondents stated that further investment in gold was driven by its status as a safe haven. Lynette emphasizes that central banks are increasing their allocation to gold due to concerns about past incidents, such as the freezing of Russian reserves by the U.S. This event demonstrated the importance of gold as a valuable asset during economic and political uncertainty. According to a survey of sovereign investors conducted by asset manager Invesco, central banks globally recorded record purchases of gold in 2022 and the first quarter of this year as they sought safe havens from high inflation and volatile bond prices. China and Turkey accounted for nearly 1/5 of these purchases. We will now bring you clips from Lynette Zang. But wait, there's more. To stay updated with all our future uploads, make sure to hit that subscribe button and turn on post notifications. Thank you and enjoy the video.
Gold buying is up and U.S. dollar holdings are down. Let me show you what that looks like. What central banks use to protect their portfolio from global inflationary trends or geopolitical risk or many other things. Well, 69% of them allocate to gold. 41% allocate to tips. When interest rates go up, market value of the bonds go down, but the longer the maturity, the greater the shift. So they shorten the maturity to reduce that volatility. But the problem is then they have to, when they have to roll that debt over, they're rolling it over into a higher interest rate, which costs more. That's true for central banks as well as individuals. So what is the safest and best thing that they allocate to? Obviously, it's gold. And we know that the dollar is dying, but we know so is the euro and the yen and the Mexican peso and every single other fiat currency out there. This is not just a US dollar issue. This is a global issue. And what are the reasons for increasing their gold allocation? A substantial percentage of central banks are concerned about the precedent set by the U.S. freezing of Russian reserves. So what they want you to think, well, that was then, this is now. No, now builds upon what was happening then. And everybody was watching as the U.S. used their global money system, the SWIFT system, to control Russia. Didn't work because Russia had gold and they used that. But 96% of central banks said that they use gold as a safe haven asset. And also for currency uncertainty. That's foreign exchange, which central banks and commercial banks use to trade with, right? To control the visible price that you see. It's the worst horse in the glue factory, but it's an awful lot of garbage. But this is the trend that blew my mind. And by the way, you know you have all the links to all of these research pieces in the blog, so you want to follow them. This is actually from Invesco, and it was a great report. I'm so glad that I found it. But gold holdings as a percentage for central banks. Okay, 2020 holdings, what they're investing now, and what they plan on doing in 5 years, right? So these were the 2020 holdings, and 73% of global central banks are in foreign banks right now. Okay, so they're physical gold, but they're held in like the Bank of England or here in the vault in the New York Fed. So, but look at this, physical gold in own country. So you had 50% of the global central banks that were holding it in their own country. There's gold derivatives and gold ETFs. So 50% were, but they anticipate that has increased, that's 2020, to 69%, and they anticipate that 74% will hold it physically in their country.
In the interview, Lynette Zang pointed out a pattern called the cup formation in the gold price chart. Each time this pattern appears, the cup gets bigger, and Lynette wonders if we're about to see a significant breakout. A rising gold price could mean that our current currency is in trouble, and we might reach the end of its life cycle. Lynette also discussed how interest rates affect the value of the dollar. When the Federal Reserve raises interest rates, people tend to prefer the dollar, decreasing the price of gold. However, she highlighted that interest rates are less important than what you can actually buy with your money and how much you earn from it. As the Federal Reserve nears the end of its interest rate hike cycle, Lynette expects the dollar to weaken, but this also depends on other governments raising interest rates. This will impact how the dollar performs against other currencies. Let's get back to the interview.
So one of the ways to value a currency is the spot gold market, and this is the graph that I show you all the time. This graph goes back to when we first went completely off a gold standard. And all it really does is reflect the trading, how they're managing the markets. It does not reflect the true fundamental value of an ounce of gold. They're taking advantage of it. You should too. But back in 1970 or prior to 1971, gold was fixed at $35 an ounce. Then when they took us off the gold standard and they went on this perception management campaign for us to think that gold had basically no value, it's just a relic, even though it's used in every single sector of the global economy. But I want to point out the cup formation, which is a key accumulation pattern. When it broke out, how much it went up, right? Went up pretty substantially, actually 825 intraday. Then the second cup, remember Y2K and how everybody was all concerned, the problem with the computers? Interestingly enough, gold spot went down during that period of time, right? Crisis brewing. We don't want people going to gold. Let's push it down. Here's your cup formation, and here's the breakout. This was 2004. I remember it really, really well. Now here is the most current cup. And I'd like you to notice that every single time the whole trend evolves, the cup formation is larger and larger. Every cup. So, are we about to experience the ultimate breakout? Because a rising gold price indicates a failing fiat currency, and we're at the end. This was the beginning of that experiment when they took us. Nixon, severed those ties, but now we're at the end. That's why everything is so confusing and extreme, because we're at the end of this currency's life cycle. Don't trust what you see on Wall Street because it's for their best interest, not yours. And in fact, Wall Street fund titans are betting on everything gaining against the dollar. And this is part of what's making me wonder if this isn't taking us back to 2007. Dollar to weaken as Fed nears end of interest rate hike cycle. Remember how much the dollar went up? Actually, let me go back there and show you. Right here, okay? When Nixon took us off the gold standard, right? This is when Paul Volcker ratcheted up interest rates to 21.5% intraday, ended up closing in like 18 something. But they lifted interest rates up, and so that attracted people to the dollar. That's why when the Fed is raising interest rates, you'll see spot gold decline, right? Because after all, interest is more important than what you can buy with the dollars and what you're earning from the interest. I hope you realize I'm being absolutely, completely facetious, okay? So that's what happens. So the dollar weakens as Fed nears the end of its interest rate hike cycle only if other governments are continuing to raise the interest rates up. So it makes it appear, one currency against another, makes it appear, oh, the dollar's stronger, oh, the dollar is weaker. But it really doesn't matter. It matters what you can buy with it.
With gold prices rising and central banks showing more interest, gold will likely remain a secure asset during economic uncertainty and market volatility. Additionally, the recent economic data has raised hopes of a potential pause in the Fed's interest rate hiking cycle, which could further boost gold prices. Do you think gold will stay a safe investment with the uncertainty in the economy and central banks buying more of it? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.